Yeah, so this really scary graph that I'm putting up here is really powerful. Okay, and I'm gonna take all these squiggly lines. This looks like an EKG or whatever, right?
Looks like an EKG.
All right, there we go. So I'm gonna make it less scary here. What this is looking at is the relationship that drives how our long-term interest rates
Mhm.
are formed. And really, what's happening here is investors actually choose to invest on the other side of our mortgage-backed our mortgages. It's called a mortgage-backed security. So there's some investor on the other side who's saying, yeah, I want to earn a 6.6% return when I invest in mortgage-backed securities. And overall, investors look to other investment opportunities and they say, well, listen, I could do this and maybe earn more return, but
Mhm.
maybe take on a little bit more risk. Or I could do this and maybe make less of a return and take less risk.
Mhm.
And so mortgages are actually pegged most closely to the 10-year treasury. And the 10-year treasury is, of course, from the federal government, which can print as much money as we want. That is viewed as a risk-free investment.
Mhm.
So if you're an investor out there and you're saying, well, listen, I might be able to earn a return from a 10-year treasury, you might say, well, if I'm going to invest in mortgage-backed securities, I'm going to need to earn a higher return on that
Yeah, you got
investment,
to
right?
pay me for my risk.
You got to pay you for your
Yeah, you got
risk.
to pay me for the risk.
So what this slide is showing is that over time, that spread has been about 1.7%.
Mhm.
And this is like 10 years from 2010 to
Yeah.
2020. So it's not up to speed. But what this should show you is that historically, that spread between the 10-year treasury
Mhm.
and the average interest rate for long-term mortgages is about 1.7%.
Okay.
And that's historically what it is. So now we got to ask ourselves, well, what's that spread right now?
Yeah.
Okay. So let's go over to the next slide here. And this is our current 10-year treasury yield. If you want to go and invest in 10-year treasuries right now, you'll earn, call it 4%.
Mhm.
Okay. So if we know that 10-year treasuries at 4% and the historical spread between that and mortgage-backed securities has been 1.7%, what would you expect long-term interest rates to be?
If the 10-year, can you say that again?
Yeah, so we know that to formulate the average 30-year fixed rate
Mhm.
mortgage
Mhm.
interest rate,
Mm.
you're basically taking the 10-year treasury,
Mhm.
and then you typically have a spread, a premium that
Mhm.
investors require.
Yeah.
And so we know that the 10-year treasury
Mhm.
right now is 4%. We
Yeah.
know that historically
Mhm.
that spread has been 1.7%.
Got it. Got it. So
What should
I would expect the interest rate to be around 5.7%.
exactly?
Yeah.
Exactly. But what is our interest rates right now?
I just got a interest rate at like 6.3 is what I got for my personal property. I know that JWB is offering right now with the incentive and with the buy down somewhere around 5.7, right?
We
Yeah.
are, and I'm really glad you mentioned that. Let's go a little bit more macro though,
All
right?
right.
Let's not go specifically for you and let's not go specifically for JWB
Okay.
because we're trying to formulate basically how the interest rates are, if they're above, if that spread is higher than what
Mm,
it should be or lower.
Okay. Well, I'm gonna guess based on what the patron Santorius put in the chat of the spread currently being 2.6, that the interest rate right now is 6.6.
Exactly. Very good. Very
I
good.
figured it out all by myself with Michael telling me the answer.
And it was on the first slide that we went through as well.
That too. That too. There's a lot going on here, Greg. I'm managing the community. I'm trying to co-host here.
You do a fantastic
I
job.
appreciate it.
So long story long here, the spread between the 10-year treasury and what our actual long-term interest rates are is much higher than historically it has been. And if you go back to October when interest rates were closer to 8% overall, the spread was even wider, right?
Mm-hmm.
So what this should represent for all of us as investors is if historically that spread has been 1.7%, and right now it's about 2.6%.
Mm-hmm.
Even if the Fed does not lower the Fed funds rate anymore, there is an opportunity for interest rates to come down even
To continue
further.
coming down. Yeah.
Right.
Mm-hmm.
And when the Fed does lower interest rates, well, if it would stay consistent with that 1.7% spread, well, then you have an opportunity for interest rates to come even lower than that.
Got it.
So all
Cool.
this being said is we have a lot of movement, potential movement. Now that the economy and the investment world and the Fed has signaled that the end of rate hikes is
Mm-hmm.
is here, we have a lot of downward momentum and potential for interest rates to come down.
So correct me if I'm wrong, GC, but this sounds like this is the most certain that you have sounded about interest rates coming down in the near future in a long time.
I'm still going to pause a little bit
Mm-hmm.
because I am very confident that interest rates are going to come down at some time, at
Mm-hmm.
some point.
Yeah.
But there's still so many variables out there with the world and some of the chaos that we have in other countries
Okay.
and other things that, I don't think it's just going to be like a slide like this. I would
Mm-hmm.
imagine it's going to be sort of a bumpy road. But yeah, I do see interest rates coming down at some point here.
Okay. All right. Cool. All right. Next slide.
Yeah. And then this was just showing what that differential is, that spread is today. So it's not 1.7 today. If you look on this slide here, it's showing that it is somewhere around 2.75 is what the spread is. And the dates on this are a little bit different than the dates that I pulled the other data. So that's the only difference between 2.6 and 2.75. You kind of can see what's happening here. It used to be 1.5 or 1.7, ballooned up to over 3 as
Mm-hmm.
that spread,
Mm-hmm.
back down to 2.7-ish.
Yeah.
And we are hoping and expecting that that spread will continue to compress.